Something quiet just happened in the UK mortgage market, and almost nobody noticed. There was no headline screaming crash, no emergency press conference, no dramatic price chart going viral on Twitter. But if you look at the data beneath the noise, something important has shifted. UK mortgage approvals have fallen again. Not by enough to cause panic, not by enough to trend, but by enough to matter. And here's why this matters more than house prices, more than asking prices, and even more than interest rates. Mortgage approvals tell you what buyers can actually do, not what sellers hope for. They tell you whether banks are confident. They tell you whether risk committees are relaxed or nervous. They tell you whether credit is flowing or quietly tightening. And right now, the flow is slowing. If you're a first-time buyer, this affects whether you even get through the door. If you're a homeowner, this affects who can buy from you next. If you're a landlord, this affects liquidity, your exit options. And if you're just watching the economy, this is one of the earliest warning signals there is. Historically, approvals fall before transactions fall. Transactions fall before prices fall. And prices fall long before the public narrative changes. That's why this data matters. Now, before we go any further, I want to be clear about something. This is not a crash video. This is not a prediction video. And this is definitely not fear content. This is about understanding what's quietly changing under the surface of the UK housing market, using the numbers banks themselves care about. Because when banks change behavior, everything else follows. Over the past few months, approvals have been drifting lower again after a brief stabilization. Not collapsing, drifting. And drifting is often more dangerous than crashing because it doesn't trigger alarm bells. What's happening isn't about one single factor. It's not just rates. It's not just affordability. It's not just regulation. It's a combination of pressure points stacking up at the same time. Banks are facing higher funding costs. Default risks are being reassessed. Stress tests are being tightened. And household finances are under more strain than headline inflation suggests. So when a borrower applies today, banks are asking different questions than they were a year ago. They're not just asking, can you afford this now? They're asking, can you still afford this if something goes wrong? And that shift, from optimism to caution, shows up first in approvals. If you've noticed mortgages taking longer, if you've noticed more requests for documents, if you've noticed valuations coming in low, if you've noticed applications being declined for reasons that feel vague, you're not imagining it. That's the system quietly tightening. And this is where it gets interesting. Because at the same time approvals are weakening, prices in many areas haven't fallen much yet. In some places, they're still flat. In others, they're even rising slightly. That disconnect between price expectations and credit reality is where stress builds. It creates stalled markets, chains that collapse, listings that sit, and buyers who can't quite get across the line. This is how housing slowdowns actually start. Not with a bang, but with friction. Before we look at what this means next, there's one more thing you should understand. The UK is unusually sensitive to mortgage tightening compared to other countries. Because we're a highly leveraged market. Because variable and short-term fixed rates are common. Because household debt sits right at the center of economic stability. When approvals slow here, it's rarely isolated. It's usually connected to something bigger. And that's what we'll get into next. To understand why approvals are falling again, you have to look at how banks actually think. Banks don't lend based on vibes. They lend based on risk models, funding costs, and regulatory pressure. And all three have shifted. First, funding. UK banks don't magically create money at zero cost. They rely on wholesale funding markets, deposits, and global capital flows. Over the past year, that funding has become more expensive and less predictable. Even when headline rates pause, the cost of certainty doesn't. Banks are paying more to secure stable funding, especially longer-dated funding. And when funding costs rise, lending standards tighten, even if rates don't move much. Second, risk. This is the part most people miss. Banks are not looking at unemployment today. They're looking at unemployment risk 6 to 18 months out. They're stress testing borrowers against scenarios where energy costs spike again, where growth slows further, where refinancing shocks hit households rolling off low fixed rates. That doesn't mean they expect disaster. It means they're pricing uncertainty. And uncertainty is toxic to approvals. Because when uncertainty rises, the easiest decision for a bank is to say no, or to say yes, but with stricter conditions. Lower loan-to-value, higher income buffers, more scrutiny. Third, regulation. Post 2008, UK banks don't get rewarded for being aggressive. They get punished. Capital requirements, stress tests, and internal risk committees all push in the same direction when conditions become unclear. And right now, conditions are unclear. Growth is weak. Productivity is stagnant. Consumer resilience is thinning. And refinancing risk is still working its way through the system. So banks respond the only way they can, by slowing new exposure. This is why approvals matter more than rate cuts. You can cut rates and still see approvals fall if banks don't trust the outlook. And here's where the global context quietly enters the picture. UK banks are not operating in a vacuum. They're watching global credit conditions, US monetary policy, and international funding stress. When US rates stay higher for longer, global liquidity tightens. When global investors demand higher returns, bank funding becomes more expensive. When bond markets wobble, risk appetite shrinks. The UK often feels this early, not because it's weaker, but because it's more exposed. So what you're seeing in approvals isn't just a UK housing story. It's a signal about credit conditions tightening globally, with the UK acting as an early pressure point. This doesn't mean collapse, but it does mean constraint. And constrained credit changes behavior. Buyers hesitate. Sellers resist cutting prices. Transactions slow. And markets drift. This is why approvals falling while prices hold is not stability. It's tension. And tension doesn't resolve itself quietly. It resolves when expectations adjust, either through prices, volumes, or time. Now, here's the key insight most people miss. The people most affected by falling approvals aren't speculative buyers. They're normal households. First-time buyers with decent incomes but smaller deposits. Upsizers relying on chains. Landlords refinancing on a harsher terms. When these groups step back, demand thins, even if headline prices don't scream yet. This is how liquidity drains from a market. And once liquidity goes, confidence follows. Which brings us to what this actually means going forward. So what happens next? Not tomorrow, not next week, but over the next several months. The most likely outcome is not a dramatic crash. It's a slow grind. Fewer approvals means fewer completed sales. Fewer sales means weaker price discovery. Weaker price discovery means longer listings and stalled chains. In practical terms, you'll see more sale-agreed deals falling through, more renegotiations after valuations, more sellers chasing the market down slowly rather than cutting sharply. This is already happening in pockets, especially outside prime London, and the data usually leads the headlines by months. If approvals continue drifting lower, the pressure builds quietly. Now, what should you watch if you want early signals? First, approvals, not prices. Second, average loan sizes. Third, rejection rates and application withdrawals. And fourth, time on market. These tell you more than any asking price index. If approvals stabilize and recover, the market breathes again. If they keep softening, friction increases. And here's the important part. None of this means the system is broken. It means it's cautious. But prolonged caution has consequences, especially in a market built on confidence and leverage. The UK housing market doesn't need panic to slow. It just needs hesitation. And right now, hesitation is spreading quietly. If you've made it this far, you're probably someone who prefers understanding systems rather than reacting to headlines. That's exactly what this channel is about. If you want to keep tracking these early signals before they turn into mainstream narratives, consider subscribing. No hype, just data and context. And I'm genuinely curious. If you're in the UK, have you noticed mortgage processes changing lately? Longer approvals, tougher criteria, or deals falling through? Drop your experience in the comments. Patterns only show up when people compare notes. Thanks for watching.